where the CBN Governor Godwin Emefiele is briefing the press.
166 billion naira has been disbursed. Consumer credit, where 527.6 billion naira has been disbursed. Oil and gas, where 477 billion naira has been disbursed. Agriculture, where 287 billion naira has been disbursed. And construction, 270 billion has also so far been disbursed. On monetary aggregates, broad money supply rose to 6.93% year to date in August 2020 from 5.23% in July 2020, reflecting the increase in both net foreign assets and net domestic assets. Similarly, aggregate domestic credit grew by 6.94% in August 2020 compared with 9.43% in July 2020. Money market rates remained relatively stable in the review period with some mild volatility reflecting the prevailing liquidity conditions in the banking system. The monthly weighted average interbank core rate increased to 7.38% in August 2020 from 6.25% in July 2020, while the open buyback OBB rate decreased to 8.39% in August 2020 from 10.12% in July 2020. The MPC noted the moderate improvement in the equities market during the review period as the all-share index increased by 5.78% from 24,174.75 on July 21, 2020 to 25,572.57 on September 18, 2020. On a year-to-date basis, however, the all-share indices decreased by 4.73% compared with 26,842 as at December 31, 2019. Market capitalization also increased by 5.98% from 12.61 trillion to 13.36 trillion over the same period. As a lead indicator, therefore, this improvement in market indices signposts the commencement of a broad-based economic recovery as far as we see today. The committee also noted the decrease in the non-performing loans ratio to 6.1% at the end of August 2020, compared with 9.4% in the corresponding period of 2019, due largely to recoveries, write-offs, and disposals. Committee expressed confidence in the overall stability of the banking system as reflected in the positive performance of the financial soundness indicators despite the persistence of COVID-19 pandemic. It, however, called on the bank to sustain its regulatory oversight on the industry in the light of the continuous fragility of macroeconomic indicators and the impact of COVID-19 pandemic and the growing risk of cyber attacks on business and economic activities. On the external sector, committee noted the resumption of sales to bureau de change in a bid to improve liquidity and ease demand pressure on the foreign exchange market. Consequently, exchange rate appreciated at all the windows. The Monetary Policy Committee observed the recent improvement in external reserves and urged the bank to maintain its prudent allocation of foreign exchange towards balancing supply and demand. The outlook. The broad outlook for the global recovery remains uncertain as the headwinds associated with COVID-19 pandemic persist, especially as new indications of a second spike in the rate of infections continues to dampen prospects of a near-term recovery. With several economies contracting deeper than expected, the global economy may eventually contract beyond the 4.9% earlier projected by the IMF, as the second round of spike in the infection rate has resulted in widespread localized lockdowns in some advanced and emerging market economies. In addition, the persisting volatility in global oil prices, which is likely to continue beyond the end of 2020, as indicated by the deliveries in the oil futures market, signposts the likelihood of a disorderly global recovery. The synchronized monetary policy accommodation by major central banks in both the advanced and emerging market economies portends the likelihood of a medium-term debt crisis, which may set the global economy into another downturn if not properly managed. On the domestic economy, staff forecasts suggest that the economy may continue to grapple with the effects of the pandemic throughout the rest of the year, with persistent focus on activities meant to reverse the contraction. MPC projects growth at positive levels during the fourth quarter 2020 or latest first quarter 2021, based on the anticipated positive results from the coordinated and sustained interventions by both the monetary and fiscal authorities. These interventions include the coordinated response of the monetary and fiscal authorities to curtail the spread of the pandemic, reverse the downturn in the economy, improve revenue sources in the non-oil sector, and encourage the build-up of fiscal buffers. Committee's consideration. Committee's considerations focused on major headwinds, exerting downward pressure on output growth and upward pressure on domestic prices and inflation. The key factors considered by committee as likely to exert upward pressure on domestic prices in the near term include the prevalence of security challenges in the country, adverse weather conditions causing flooding in some farming regions, the increase in petroleum pump price, the regulation in the electricity tariffs, low crude oil prices, and exchange rate adjustment. The committee noted that available evidence does not support the view that the rise in inflation was due to monetary factors. Rather, there is overwhelming evidence that the inflationary pressures reflect the prevalence of structural rigidities and supply shocks. Hence, the traditional tools of monetary policy may not be helpful in addressing current inflationary pressures. Instead, the useful policies will be the supply-side measures implemented by the CBN. In the light of this, reducing MPR will signal to our deposit money banks to lend more to stimulate growth, increase aggregate supply, which should dampen prices in the immediate term. Although the committee remains committed to its primary mandate of ensuring price stability, it, however, noted the need to address the structural supply-side issues that are putting upward pressure on production cost and depressing economic growth. To this end, committee supports the various intervention programs of the bank towards stimulating production in the agricultural and the manufacturing sectors to increase aggregate output and lower prices. On financial markets, committee considered the impact of the dwindling capital flows on yields in the equities, bonds, and money markets. It, however, observed the improvement in the equities market from the second quarter of 2020, indicating prospects of medium-term economic recovery. Members also took cognizance of the prevailing low rates in the money market and below the lower band of the standing facilities corridor as being a distortion to money market operations. Committee noted the increase in aggregate credit and encouraged further expansion in credit to employment-generating sectors to expedite growth recovery. It, however, urged the bank to sustain its regulatory surveillance over the banking system to ensure that non-performing loans remain low. Committee also noted the rising public debt profile and urged the fiscal authorities to strengthen its debt management strategy, explore other sources of revenue, as well as enhance efficiency in public expenditure. It commended the combined efforts of the federal government and the CBN in providing the required stimulus to contain the pandemic and ease its impact on the Nigerian economy. The dilemma of monetary policy. The MPC was at this meeting confronted by policy dilemma. Whereas MPC believes in the primacy of its price and monetary stability mandate, it nevertheless was confronted with what policy directions to focus on given the contraction in output growth during the second quarter of 2020, which may lead to a recession if the third quarter of 2020 output growth numbers further show a contraction. It is therefore of the view that if a recession occurs during the third quarter of 2020, the committee will be confronted with proposing policy options in a period of stagflation. This is because with the recent removal of subsidy on fuel price, the increase in energy prices, and the adjustment of the exchange rate, inflationary pressure will no doubt persist unless MPC considers options that will deal with the pressure aggressively. Committee was therefore of the view that to abate the pressure, it had no choice but to pursue an expansionary monetary policy using development finance policy tools targeted at raising output and aggregate supply to moderate the rate of inflation. At present, fiscal policy is constrained and so cannot on its own lift the economy out of contraction or recession, given the paucity of funds arising from weak revenue base, current low crude oil prices, lack of fiscal buffers, and high burden of debt services. Therefore, monetary policy must continue to provide massive support through its development finance activities to achieve growth in the Nigerian economy. This is the reason MPC will continue to play a dominant role in the achievement of the goals of the Economic Sustainability Program through its interventionist role to navigate the country towards a direction that will boost output growth and moderate the level of inflation. Similarly, given that the currency adjustment was a causal factor in determining the price of petroleum products and energy prices, MPC believes that the CBN management must take bold actions to stabilize the exchange rate. Management was further enjoined by the MPC to continue to provide funding to sectors that will resolve the supply constraints in petrol pricing, energy pricing, and food availability. To support household consumption, MPC enjoined management to aggressively channel its funding to targeted households, small and medium enterprises, and consumer credit by further increasing its lending activities through its Nielsen Microfinance Bank. The management was also directed to ensure that deposit money banks respond to the reduction in deposit rates by aggressively lowering cost of credit to borrowers. As regards output growth, MPC noted that air and road transportation, entertainment and accommodation, food services, and education subsectors were adversely impacted by the lockdown. It therefore suggested that more efforts be put in place to continue to provide relief and funding to these subsectors so as to catalyze growth and improve output numbers. Dealing with the causal factors of inflation. In the view of the MPC, so far, evidence has not supported the rise in inflation to monetary factors, but rather, evidence suggests non-monetary factors, here we're talking about structural factors, as the overwhelming reasons accounting for the inflationary pressure. Accordingly, the implication is that traditional monetary policy instruments are not helpful in addressing the type of inflationary pressure we are currently confronted with. What is useful is the kind of supply-side measures currently being implemented. MPC also expects that a downward adjustment in monetary policy rate may be necessary to further put pressure on our deposit money banks to lower cost of credit in aid of growth. Committee's decision. In the face of declining economic growth and rising inflation, the committee faced a difficult set of policy choices requiring trade-offs and sequencing. Following the above considerations, committee reviewed the choices before it, bearing in mind its primary mandate of price stability and the need to support the recovery of output growth. Consequently, committee noted that the likely action aimed at to addressing the rise in domestic prices would have been to tighten the stance of policy, as this will not only moderate upward pressure on prices, but will also attract fresh capital into the economy and improve the level of the external reserves. It, however, noted that this decision may stifle the recovery of output growth and thus drive the economy further into contraction. On easing the stance of policy, the MPC was of the view that this action would provide cheaper credit to improve aggregate demand, stimulate production, reduce unemployment, and support the recovery of output growth. Committee, however, observed that with inflation trending upwards, easing of the policy stance may exacerbate the current inflationary pressure through an increase in money supply. In addition, MPC noted the tendency of an asymmetric response to downward price adjustments by other depository corporations, thus undermining the overall beneficial impact of a reduction to the cost of capital. In the committee's view, a hold position would allow the economy to adjust to the ongoing stimulus measures put in place by the monetary and fiscal authorities to curb the downturn and allow more time for the MPC to assess their impact on the Nigerian economy. After the consideration of the three policy options, members were of the opinion that the three options to lose will complement the bank's commitment to sustain the trajectory of the economic recovery and reduce the negative impact of COVID-19. In addition, the liquidity injections are expected to stimulate credit expansion to the critically impacted sectors of the economy and offer impetus for output growth and economic recovery. In view of the foregoing, committee decided to reduce the MPR by 100 basis points to 11.5% and adjust the asymmetric corridor to plus 100 and minus 700 around the MPR. 6 members voted to reduce MPR by 100 basis points, 1 member by 50 basis points, and 3 voted to hold. 9 members voted to change the asymmetric corridor, while 1 member voted to hold. All members voted to hold the CRR and the liquidity ratio. In summary, MPC voted to 1. Reduce the MPR by 100 basis points from 12.5% to 11.5%. 2. Adjust the asymmetric corridor from plus 200 and minus 500 basis points to plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5%, and 4. Retain liquidity ratio at 30%. I thank you immensely for your attention.